In today's video, we'll be looking at the different types of loans. Before we get into the specifics of each loan type, let's first understand what a loan actually is. A loan is a financial obligation in which an amount of money, the so-called loan amount, is provided by a bank or a lender. You are required to repay this amount over a specified term and pay interest on the outstanding amount. Depending on the type of loan, you may pay only the interest, only the principal, or both in a particular structure. The right type of loan depends on your financial goals, budget, and the type of investment you intend to finance. Let's start with the bullet loan, also known as a balloon loan. With this type of loan, you pay only the interest during the entire term. The actual loan amount, that is, the borrowed amount, is repaid in one lump sum at the end of the term. So here we have a monthly interest payment, no principal repayment during the term, and a full repayment at the end. Let's consider an example. You take out a bullet loan of $10,000 with a term of 5 years and an interest rate of 5%. This means you only pay the interest each month, amounting to $500 per year. However, at the end of the 5 years, you'll need to repay the entire loan amount in one go. A bullet loan is especially interesting if you expect to have significant funds at the end of the term, for example, from a maturing life insurance policy or an investment you're building up in the meantime. However, it can also be risky due to the large payment due at the end. Now let's move on to the amortizing loan. This type of loan works differently. Here, you repay the loan amount in fixed installments of principal spread over the term. This means you pay a fixed principal amount each month plus the interest. So we're dealing with a fixed monthly principal repayment and decreasing interest payments, which reduces the overall monthly installment. Here's an example. Imagine you take out an amortizing loan of $10,000 with a term of 5 years and an interest rate of 5%. The principal repayment is $2,000 per year. This means that in the first year, you pay interest on the full $10,000, which is $500. In the second year, the outstanding loan amount drops to $8,000, so you only pay interest on that amount, $400, and so on. This way, the installment decreases each year. The amortizing loan is ideal if you want to remain flexible and adjust to decreasing monthly payments. However, you'll need to budget for higher amounts in the early years, as the interest charge is initially applied to the full loan amount. The annuity loan is the most common type of loan and is often used for real estate financing. Here, the monthly payment remains the same throughout the entire term, making the cost predictable. So we're dealing with a fixed monthly payment where the portion of interest decreases and the principal portion increases. Here's an example. With an annuity loan of $10,000 and an interest rate of 5%, you pay a fixed monthly installment, in this case $2,264. Initially, this installment mostly consists of interest and only a small portion of principal repayment. Over time, the outstanding balance decreases and the interest portion gets smaller, while the principal portion of the installment increases. This means you pay off the loan continuously through the fixed installments. An annuity loan is especially suitable if you want to budget for fixed monthly payments and are comfortable with a steady cost. Due to the consistent payment, it's also ideal for long-term financing, such as for purchasing property. To conclude, let's compare these three types of loans once more. Bullet loan. Interest payments only during the term. Large final payment. Amortizing loan. Decreasing monthly installments as the interest portion decreases with each principal repayment. Annuity loan. Fixed monthly installments, predictable, ideal for long-term financing. Ultimately, choosing the right loan depends on your personal and financial priorities. We hope this video has helped you understand the topic of the different types of loans. See you next time and have a good one.